Most people think the key to retirement tax planning is simply deferring taxes as long as possible. But after working with hundreds of retirees, I've learned that the real opportunity isn't in deferring, it's in strategically choosing when to pay taxes, at what rates, and on your terms rather than the IRS's timeline. Hi, I'm Mark Fonville, CEO and Certified Financial Planner here at Covenant Wealth Advisors in Richmond, Virginia. Today, I'm going to walk you through a Roth IRA conversion framework we call filling the brackets, a strategy that could potentially help you pay substantially less in lifetime taxes by taking advantage of a strategic window you may have right now. Before we dive into the strategy, let's make sure we're clear on something fundamental that a lot of people misunderstand about traditional IRAs and 401ks. When you contribute to these accounts, you generally get a tax deduction today. That feels good, but here's what's actually happening. You're not avoiding taxes, you're entering into a partnership with the IRS. They're your silent partner on every dollar you've saved, and they're patient. They'll wait decades if necessary. The critical moment comes at age 73 or 75, depending upon your date of birth, when required minimum distributions kick in. Now, whether you need the money or not, the IRS forces you to start withdrawing a percentage of your account balance every year. These aren't small percentages either. They start at about 3.65 to 3.8% and increase as you age. So let me walk you through what this looks like with specific numbers. Let's say you're 65 today with $1.5 million in your traditional IRA. You're planning to let it grow until you're required to take distributions. At a reasonable 6% annual return by age 73, that account grows to roughly $2.4 million. Your first required distribution? Well, it's about $90,000. Now, here's where that trap closes. The $90,000 doesn't exist in isolation. It gets stacked on top of your Social Security benefits, any pension income, investment income from taxable accounts, everything. If you're married and your combined income pushes you into the 32% federal bracket, which in 2026 starts over $403,550, you might be paying nearly $29,000 in federal taxes on that distribution alone. And that's every year, with increasing distribution requirements as you age. But here's what most people miss. You may have a window right now if you have recently retired or your income has possibly dropped due to a reduction in employment income, possibly lasting several years, where you can pay taxes at rates that are substantially lower than what you'll face later. So let's talk about the counterintuitive strategy that can potentially save six figures in lifetime taxes. Though I should note, actual results will of course depend on your individual circumstances, future tax laws, and market conditions. The idea is simple though. Instead of waiting until you're forced to take distributions at potentially higher tax rates, you voluntarily convert portions of your traditional IRA to a Roth IRA during years when your income is low and you're in lower tax brackets. Now, I know what you're thinking. Why would you choose to pay taxes? Well, here's the math that makes this work. Let's say you're in early retirement. Maybe you've stopped working, but you haven't started Social Security yet. Your taxable income this year is $50,000. For married couples filing jointly in 2026, the 12% tax bracket goes up to $100,800. That means you have nearly $50,800 of room in that bracket. You could convert $50,800 from your traditional IRA to a Roth, and you pay just 12% in federal taxes, which is about $6,100. That money is now in a Roth account where it grows completely tax-free from here forward. Compare that to the alternative. If you leave that same amount in your traditional IRA, it eventually comes out as part of your required minimum distributions. When it does, you might be in the 32% bracket paying over $16,000 in taxes on the same money. That's nearly 3 times more in taxes. And this is what I mean by filling the brackets. You're strategically using up your lower tax brackets while you have access to them before Social Security starts, before RMDs kick in, before you potentially lose these historically low rates to future tax law changes. And here's the powerful part. Once money is in a Roth IRA, it grows tax-free forever. No taxes on the growth, no taxes on withdrawals in retirement, and no required minimum distributions at age 73. You've essentially prepaid the taxes at a discounted rate. Over a 20 or 30-year retirement, depending on your specific situation and market performance, this strategy could potentially result in significant tax savings, though I should emphasize that individual results will of course vary based on, again, income, tax situation, account balances, and future conditions we can't predict. If you like what you're hearing, by the way, be sure to go ahead and like this video and click the subscribe button so you'll be notified when we produce new content. So, who benefits most from this strategy? Well, this approach isn't appropriate for everyone, but certain situations create ideal opportunities. The sweet spot is typically between ages 60 and 72 during what I call gap years. Those years after you've retired from work, but before Social Security begins and before required minimum distributions start. During these gap years, your taxable income might be substantially lower than it was during your working years or will be later in retirement. So let me share a hypothetical example to illustrate how this might work. Let's say Chris and Cindy are both 65 and recently retired with $1.7 million in traditional IRAs. They're living on $30,000 in annual investment income and some savings. They haven't started Social Security yet. Looking at their tax return, they're solidly in the 12% bracket. But we can see what's coming. In 8 years, Social Security starts. A few years after that, RMDs begin. Their future tax picture looks much higher than their current one. So they decide to systematically convert about $70,000 each year to Roth accounts. This keeps them in the 22% bracket or lower, and they're paying roughly $10,000 to $12,000 annually in taxes on these conversions. They do this consistently for 8 years until Social Security begins. By that point, they've moved over $560,000 from traditional IRAs to Roth accounts, paying taxes at 12% to 22% rates. When their RMDs eventually start, instead of being forced to withdraw from a $2.7 million traditional IRA, assuming growth of course, they're withdrawing from a smaller balance, let's say roughly $1.5 million. Their RMDs are a fraction of what they would have been, keeping them in lower tax brackets throughout retirement. Now, keep in mind, this again is a hypothetical scenario for illustration purposes and does not represent actual client results. Your outcome, again, will depend on your specific income and account balances, market returns, and just changes in tax laws. Now, other situations can create similar opportunities. Maybe you're between jobs. Maybe you're a business owner experiencing a lower revenue year. Maybe you retired at 62 and have several years before Medicare and Social Security began. Any of these can create tax planning windows worth examining. One important consideration if you're approaching age 63, converting too much can trigger Medicare premium surcharges called IRMA, or income-related monthly adjustment amounts. Medicare looks back 2 years when setting your premiums. So your income at 63 determines your Medicare cost at 65. Now, this doesn't mean you shouldn't convert, but it does mean you need to be strategic about staying under certain income thresholds during those specific years. So how do you figure out what makes sense for your specific situation? The calculation can be complex and often requires help from a financial advisor. To simplify it, first, you need to know your current taxable income. Add up all your income sources for 2026, wages, pensions, Social Security, investment income, rental income, everything that appears on your tax return. Next, subtract your standard deduction. For 2026, that's $32,200 for married couples filing jointly, or $16,100 for single filers. If you're 65 or older, you get an additional deduction of roughly $1,600 per person. This gives your taxable income the amount that's actually subject to ordinary tax brackets. Now you need to decide which bracket you want to fill up to. This is where judgment comes in and where your individual situation matters. For many clients we work with at Covenant Wealth Advisors, staying in the 22% bracket makes sense. That tops out at $211,400 of taxable income for married couples in 2026. Some people with substantial assets might even consider filling into the 24% bracket, which again goes up to $403,550. Generally speaking, your conversion opportunity is simply the top of your target bracket minus your current taxable ordinary income. So let's work through a specific example. Say you're married with $60,000 in taxable income after deductions. The top of the 22% bracket is $211,400. Subtract $60,000 and you have $151,400 of conversion room while staying in the 22% bracket. Now, here's something critical about execution. The simplest way to pay taxes on the conversion is to pay from funds outside your IRA. We don't generally recommend that you withhold taxes from the conversion itself, although I want to note that there are reasons to withhold taxes on the conversion in certain situations, but we'll leave that for another video. Here's why paying from funds outside your IRA does matter though. If you convert $100,000 and pay the taxes from a savings account or taxable investment account, the full $100,000 goes into your Roth to grow tax-free. But if you withhold 22% for taxes, only $78,000 makes it into your Roth. You've lost over $20,000 of potential tax-free growth. Plus, if you're under age 59 and a half, that withholding gets treated as a distribution and triggers a 10% penalty. Over 20 years at 7% growth, that difference between converting $100,000 versus $78,000 could mean giving up nearly $100,000 in tax-free wealth. And timing matters too. Unlike IRA contributions, which you can make up until April 15th of the following year, Roth conversions must be completed by December 31st. The money needs to be out of your traditional IRA and into your Roth IRA by year end for it to count for 2026. I typically recommend initiating conversions by mid-December just to ensure everything processes in time at your custodian like Fidelity or Schwab or elsewhere. Now, there are a few technical issues that can complicate this strategy, and it's worth understanding them up front. The first is the pro rata rule, which affects people who have made non-deductible contributions to traditional IRAs. Here's how it works. The IRS looks at all your traditional IRA money aggregated together when determining how much of a conversion is taxable. So let's say you have $500,000 in traditional IRAs and $50,000 of that came from non-deductible contributions you made over the years. You decide to convert $50,000 thinking you can convert just the after-tax portion tax-free. Unfortunately, that's not how it works. The IRS says 10% of all your IRA money is after tax, so only 10% of your conversion is tax-free, just $5,000. That other $45,000 is fully taxable in this example. This can significantly reduce the efficiency of strategic conversions. The solutions are either to convert everything over time, rolling existing IRA balances into a 401k if your plan allows it, or work with an advisor to navigate these rules carefully. The second issue is state taxes. Everything I've discussed focuses on federal taxes, but you need to consider your state's treatment of Roth conversions too. Most states tax conversions as ordinary income, but states like Pennsylvania don't tax IRA distributions, which changes the math. If you're planning to move states in retirement, the timing of your conversions relative to that move could matter significantly. The third consideration is once you execute a Roth conversion, it's permanent. Before 2018, you could recharacterize and undo a conversion if the market dropped or if you changed your mind, for example. That's no longer allowed. Once the conversion is complete, it's done. So you want to be confident in your analysis before moving forward. One more note on Medicare, by the way, for those in their early 60s, converting large amounts at age 63 could trigger IRMA surcharges at age 65. Those surcharges start kicking in at modified adjusted gross income above $218,000 for married couples. It's not that you can't convert above those thresholds, it's just that you need to factor in the additional Medicare premium costs, which can add several $1,000s per year for every year the surcharges apply. So let's step back and think about what this strategy really represents. The fundamental insight is that tax planning isn't just about minimizing taxes this year. It's about optimizing your lifetime tax bill. Sometimes paying some tax today at a known low rate is substantially better than being forced to pay more tax later at unknown, potentially much higher rate. This requires shifting from a narrow focus on how do I pay the least tax this year to a much broader question: how do I structure my retirement income and withdrawals to minimize total lifetime taxes while maintaining the flexibility in cash flow that I need? That shift from annual optimization to lifetime tax strategy is really what transforms this from a one-time decision into a multi-year systematic approach. The most effective implementations I've personally seen involve consistent, moderate conversions over several years rather than large one-time moves. It also requires thinking probabilistically about the future. We don't know what tax rates will be in 10 or 20 years. We don't know what your income will be or what the markets will do, but we can make reasonable assumptions, run scenarios, and make decisions that are likely to work out well across a range of possible futures. For many people, especially those with substantial traditional IRA balances, the math strongly suggests that paying some tax now at 12% or 22% rates is likely better than hoping for lower rates later when RMDs force large distributions. Though, as with any financial strategy, your individual circumstance will of course vary, as I've mentioned. And again, this just does require careful analysis of your specific situation. So if this strategy potentially applies to you, here's what to consider before December 31st. First, look at your projected income for your current calendar year. If you're experiencing a lower income year than usual, you may have a one-time opportunity to convert at rates you won't see again. Number two, think about your multi-year tax trajectory. Are you in your early 60s with several years before Social Security? That's multiple years of potential conversion opportunities. Are you 72 with just 1 year left before RMDs? The window is closing, but there may still be value. And then three, consider whether you have the liquidity to pay conversion taxes from outside your retirement accounts. This is essential for the strategy to work optimally. And then fourth, recognize that it's complex enough that trying to optimize it yourself without proper analysis really could lead to costly mistakes. The IRMA implications alone require careful income projection. The pro rata rule calculations can get complicated. And getting the execution right, the timing, the amounts, the proper tax payments matters significantly. So if you're interested in seeing how this might apply to your specific situation, we offer a complimentary retirement assessment where we can review your current tax picture, income picture, project your future tax situation, and just determine whether strategic conversions make sense for you. There's really no obligation, just a clear analysis of your options. You can visit our website at covenantwealthadvisors.com to schedule, or just use the link in the description below. If you found this helpful, please share it with someone planning for retirement, and consider subscribing to the channel for more retirement planning insights. Thanks so much for watching.